Most traders overcomplicate technical analysis. They stack multiple indicators, chase signals, and wonder, why doesn't this work? Today, I'll show you 5 trading indicators that actually work across scalping, day trading, and short-term swing trading. We'll also discuss how professionals interpret them differently compared to beginners, which will change the way you think about indicators. This is a technical analysis video for beginners, but I promise you, if you're experienced, you'll still pick up at least one technical analysis tip to start using right away. If you're ready as I am, let's get into it. Some would say technical analysis is about making price predictions, but let's look deeper. What it's actually about is about measuring market behavior. And to do that, we analyze price movement, market momentum, and participation. The relative strength index is one of the tools that can help with that. And it's one of the most popular trading indicators and at the same time, one of the most misused. Many traders believe the RSI doesn't work because when using it, they rely on one simple rule: buy at 30 and sell at 70. In reality, what the RSI actually measures is momentum pressure and not overbought and oversold conditions. It tells you how aggressive price is moving compared to its recent behavior. In scalping and day trading, the RSI becomes powerful when you stop using it as a reversal tool and start using it for trend validation. Here's what most traders get wrong. They expect the RSI to provide perfect turning points, or they use the RSI in isolation. Markets don't work that way. The RSI performs best when used during pullbacks and not extremes. This is why we ignore the RSI in low volume or sideways markets. It's simple, not reliable in those conditions. If this video is already bringing some clarity, do me a favor, hit the like button because your engagement helps this content to reach traders who actually want to learn. The average directional index is one of the most underrated indicators in technical analysis, mostly because it doesn't provide flashy and dramatic buy and sell signals. The ADS measures trend strength and not direction, and that makes it invaluable. In scalping, most losses come from trading in untrending markets. The ADS solves that problem by telling you whether the market is worth your attention. The ADS above 20 or 25 means the trend has strength, and the ADS below this level means that the market is weak or ranging. Using the ADS as a filter and not a trigger can protect your capital by keeping you out of low quality environments. Most beginners skip the ADS because it feels boring, but boring tools protect accounts, and knowing how to use them properly can prevent you from overtrading in dead markets. Remember, not every market or trend is worth trading. If the ADS tells you when to look for trades, the Parabolic SAR tells you which side of the market you should be on. What the Parabolic SAR actually does is to track trend persistence and trailing pressure. It answers one key question: is the current move still valid? Professional traders use the Parabolic SAR primarily for trade management and not for predictions. In scalping or swing trading, this is crucial because getting too emotional can mean exiting profitable trades too early. The Parabolic SAR helps you to stay objective when the momentum is still going. Most beginners often flip positions every time the dots change, while experienced traders wait for context. Context in this case means direction, volatility, and momentum confirmation. The Parabolic SAR performs best in action during clean and directional markets, and worst during low volatility markets or in consolidating conditions. Knowing when to use this particular indicator for best result is what separates professionals from reactive traders. Next up is the rate of change. The rate of change represents raw market momentum, and that's exactly why professionals respect it. It measures how fast the price is accelerating and decelerating without smoothing or delay. This makes it extremely useful for scalping strategy timing. Beginners often treat the ROC like the RSI and use it to look for overbought and oversold levels. But that's not where it shines. The thing to watch is momentum expansion and contraction. When the ROC is accelerating but price is stalling, the momentum is weakening. And when the ROC stabilizes as price holds structure, continuation becomes more likely. The ROC is especially useful during active sessions, where speed matters more than precision. Finally, the exponential moving average. This one is mostly about market positioning. Unlike the simple moving average, the EMA is quick to respond to price changes, which makes it especially useful for scalping and day trading. Most traders, including myself, use the EMA to identify dynamic support and resistance, trend bias, and trend location. We don't use it for signals. Remember that price holding above the rising EMA shows bullish acceptance, and price struggling below a falling EMA shows bearish pressure. Most traders misuse the EMA by waiting for crossovers, which are often late. Experienced traders observe how price reacts to the EMA, not when it crosses it. The EMA works best when combined with momentum confirmation and market structure. Alone, it's neutral. What gives it its meaning is the context. Here's the truth most trading videos won't tell you. Indicators don't fail, but execution does. If you focus on clarity and patience, your indicators will start working with you and not against you. If this video helped clarify technical analysis for you, hit the like button because it tells me what content to double down on. If you want to continue building real skills, your next step is to watch the best stocks to invest in right now and the best reversal trading strategy ever. Those videos connect directly with what you've learned today. Here's the mindset I want to leave you with. Technical indicators doesn't replace thinking, they just support it. Drop a comment and tell me which indicator do you understand better than before. And remember, trading isn't just about being right all the time. The key is being prepared and consistent. Every clear decision you make strategically, even if it proves to be wrong, moves you forward. Keep learning, keep showing up, and stay focused. I'll see you in the next video.
Olymptrade. Care that counts.